Australian experts warn Trump's 50-year mortgage is a recipe for disaster. Donald Trump's latest big idea for housing affordability, a whopping 50-year mortgage, might sound like a lifeline, but Australian financial experts are warning it's less a solution and more a recipe for disaster. As Aussies grapple with a cost of living crunch and an RBA poised to hold rates, the consensus is clear. This American import won't fix our property woes, it'll just make them worse. With tomorrow's cash rate call looming, and all 35 experts in Finder's RBA cash rate survey predicting a hold at 3.6%, which is what happened this afternoon, Australian households are desperately seeking financial relief. A staggering 43% of Aussies have less than $1,000 in savings, according to Finder's Consumer Sentiment Tracker, highlighting the immense pressure on family budgets. 43% of Aussies have less than $1,000. But it's these pesky broke consumers that keep spending, buying too many lattes, causing the CPI to rise. Nothing to do with anything else, of course, you silly, silly consumers. Trump's 50-year mortgage madness, why Aussie experts say no thanks. Across the Pacific, the Trump administration recently floated the concept of a 50-year mortgage repayment plan, ostensibly to make housing more accessible. However, when Australian experts were asked to weigh in, the response was overwhelmingly negative. A significant 79%, or 22 out of 28 panellists, believe that these ultra-long mortgages are not a good tool for improving housing market accessibility here. Stella Hung-Fu from the University of Sydney said while 50-year mortgages lower monthly repayments, they won't make housing cheaper. In most cases, it actually allows people to borrow more, which pushes prices even higher. Buyers end up paying far more interest over their lifetime, carrying debt for decades longer, and building equity much more slowly, Hung-Fu said. But something the US do offer is actual 30-year fixed-rate home loans, to the benefit of the citizen, unlike Australia, where we are focused on supporting corporate profits. What's wrong with Australian mortgages? They're fixed for shareholders, not homeowners. If you're paying off a mortgage or aspiring to, imagine if you didn't have to worry so much about rising interest rates. That's already the reality for US home buyers. Unlike in Australia, most mortgages in the US have a fixed interest rate, locked in for 30 years. Instead of having to wait and see if their central bank raises rates each month, a US 30-year fixed mortgage at 2% will still have the same monthly repayment, even after a rate rise. So remember when the rates were around 2% a few years ago? Many US citizens locked that rate in for 30 years. Imagine that! There is no reason why Australian lenders couldn't offer 30-year fixed-rate mortgages. After all, there's an active government bond market with maturities from 1 to 30 years. This provides a benchmark to price mortgages, just like in the US. Fixed-rate mortgages have become much more popular in Australia in the past few years. The proportion of new mortgages that were fixed jumped from about 15% in June 2019 to more than 45% by September 2021. But even those loans are typically fixed for only 3 years, sometimes as short as 1 year, sometimes as long as 5 years. After that, the rate reverts to the variable rate, so you're always exposed. Longer fixed-rate loans would insulate Australian borrowers from big swings in interest rates. In the US, you can refinance a 30-year fixed mortgage if long-term rates drop, so you benefit if rates go down but are protected if they go up. Does anyone else read this and think to themselves, we've been totally stitched up here in Australia? And this article, it's highlighting there is absolutely no reason why we couldn't have this here, except for corporate profits. Another idea to improve loan contract terms for borrowers, long advocated by University of Melbourne economist Kevin Davis, is the so-called tracker mortgage. These contracts limit borrowers to paying a certain spread over a benchmark interest rate. Such offerings depend in large part on competition in the banking sector. The US has lots of competition in banking, Australia has very little. When costs go up, two groups can bear that cost, customers or shareholders. In Australia, when bank funding costs go up, customers bear pretty much all of the cost, and shareholders zero. That's the best evidence you'll ever get of true market power. And when they say true market power, they're talking about the totalitarian power of the banks to not have to bear any of the cost because they know you and I can do nothing about it. Now back to this 50-year mortgage idea. Dale Gillam from Wealth Within said increasing the mortgage length benefits the lenders far more than it benefits consumers. Great. Australia has this unique love affair with property, and we need to look deeper into why this is, he said. Further, we need to look at what is driving prices to unrealistic levels. In the last 40 or so years, housing affordability has gone from around 4 times the average wage to over 8 times. As it stands, due to government compliance, taxes and fees, building new homes is far from affordable and in many cases is not viable for investors. We need to fix the systemic issues first before we make loans more accessible, as this will only pour more fuel on the fire, with the financial institutions the big winners. And as we've just seen, these financial institutions don't need any more leg ups to profit from us. Shane Oliver from AMP noted, this will just mean people will end up paying even more in interest payments without doing anything to improve affordability. Despite the strong opposition, a few experts saw potential. Nicholas Gruen from Lateral Economics said 50-year mortgages could be a good tool. Debt needs to be serviced, not paid off. For so long as we treat housing as an asset market, that's how we should see it, he said. Leanne Pilkington from Lang & Simmons agreed. Affordability is a major issue and it makes sense to explore every potential solution available, Pilkington said. So there you have it. Now, I did a few numbers looking at a $1 million loan on a 5% interest rate over 30 years, compared with the same variables on a 50-year loan. The total amount paid on the 30-year was just under $2 million, and on the 50-year around $2.8 million. So yeah, a big bump for the banks. But again, we don't have long-term fixed rate mortgages, so that rate realistically wouldn't stay at 5%. And if it goes up, that total amount payable would explode higher. But what do you think about all this? Should we be offering 50-year mortgages in Australia? Should we be offered the 30-year fixed-term mortgages, just like in the US? Do you think that'd have an effect on our affordability issue? It's an interesting thought. Maybe you think we need more competition within the banking sector in Australia. Let me know your thoughts in the comments below. And if you're liking the content, hit that like and subscribe button and we'll be back with more soon.